Well, economic data out of the US this week has been pretty much positive, which has put investors on edge. Now, a strong economy could mean more rate hikes and limit the possibility of a soft landing. Initial jobless claims dropped for the week of September 2nd to its lowest level since February, showing that the labour market remains resilient. Well, now the Fed is meeting again in just a couple of weeks, and investors are expecting a pause in rate hikes this time, but more and more anticipating more tightening later in the year. Now, we've heard from some Fed leaders recently who sound pretty positive about where we are. Let's start with Chicago Fed President Austin Goolsbee on Thursday, seemingly leaning towards an end to rate hikes, saying that we're approaching a place where it isn't about how high rates should go, but, quote, how long do we need to keep the rates at this position before we're sure that we're back on the path to the target? And Federal Reserve Bank of New York President John Williams recently said, quote, I think we've got monetary policy in a very good place in terms of we have a restrictive stance on policy. Well, joining me now is Matt Stucky, Northwestern Mutual Wealth Management Senior Portfolio Manager for Equities. Thank you for joining me this morning. So obviously we're getting our last bits of Fed speak today before they enter that blackout period ahead of the September meeting. What sort of position do you think the Fed is now in at the end of this week of economic data?
Look, we think, broadly speaking, the Fed's in a restrictive state just in terms of what the impact has been so far on the economy. You've seen the economy decelerate the last 12 months or so. We think from here, it's likely that we are very close to the end of this current hiking cycle. We might get another increase of the Fed funds rate in November. It's unlikely that we'll see it in September here, but we're getting close to the end. But the important point here is not necessarily so much the future direction in terms of an incremental hike or so. It's the extent to which the Fed is going to keep rates elevated at a restrictive level. And to that point, we do think it's going to be a while until they start to cut.
I mean, Dallas Fed President Lori Logan also weighed in saying, a skip in rate hikes would be appropriate, referring to the September meeting, which is widely expected, especially based on the CME Fed Watch tool as well. But she also said that in today's complex economic environment, returning inflation to 2% will require a carefully calibrated approach, not endless buckets of cold water, essentially saying this pace that we've been seeing of these rate hikes, as you mentioned, they're coming to a close here. But then what's next then in terms of a soft landing? Because you said there's a low probability of that happening.
Yeah, and just to touch again on kind of where the Fed's at and what they're looking for to eventually start to reduce rates. The Fed is laser focused on the labor market, and with wage levels and the growth of wages still elevated above 4%, just ticking down that 4.5% with the latest labor market report, that's still too high for the comfort level of the Federal Reserve. And to that extent, to my earlier comment, we think that they're likely to stay in restrictive territory. Now, you brought up, the likelihood of a soft landing. I think anytime we're talking about a Fed hiking cycle, recession needs to be our base case versus soft landing. And here's why. Go through every Fed hiking cycle since World War II. There's been 13 of them. 10 out of 13 of those hiking cycles have resulted in some form of a technical U.S. recession. Of course, there's more significant and severe ones versus more milder versions of a recession. But I think the idea with those odds that we're pointing towards a soft landing, I think is just isn't synonymous with history. In fact, if you kind of force me to make a call in terms of, are we going to have a higher likelihood of recession versus the historical norm, or a lower probability versus the historical norm, I would actually lean towards higher. And here's why. We've been in the fastest and steepest kind of reversal of monetary policy in the form of this hiking cycles in over 40 years. And we really haven't felt the lagged effects of kind of all of this running through the financial system. And so, we'll stay tuned, but we're kind of more in the camp of recessionary outcome versus soft landing.